So now, what is money market? Money market is a market for short-term securities, correct? So whenever we issue securities for less than 1 year, those securities are called money market instruments. These money market instruments, now we discussed that in length in the reading of fixed income instruments, but money market instruments are CDs, certificate of deposits. CPs are commercial paper, repo, bankers acceptance, treasury bills issued by US government or any government. So these all securities are issued for less than 1 year. They can be from overnight, 1 day to 1 year. Now, what's the difference between a money market security and a capital market or a bond? A typical bond is issued for more than 1 year. Money market is for less than 1 year. Correct? But tell me one thing. If a security is issued for less than 1 year, does it make sense that the security pays you coupon?
No.
No, it doesn't make sense. So money market securities are therefore issued. Most of these securities are issued at discount and redeemed at par, much like a zero coupon bond. Okay. So the discount that you are going to get is itself the yield on the bond. Am I correct? So let's say if a $100 security, $100 par security is issued at 95. So that $5 is going to be your reward. That's going to be your yield. Clear? Now, that's very different from a typical bond instrument, because in bond instruments, they are not like zero coupon bonds and you get coupons regularly at every intervals, right? So that's the biggest difference between a money market and a bond security. I'll repeat again that money market securities are issued at discount and redeemed at par, most of them. But bond securities they pay you annualized or semi-annualized coupon, right? So how are yields calculated in bond market? Well, yields in bond market, basically YTM, that is annualized and compounded. We do generally 1 plus R raised to T, which is 1 plus rate yield raised to 2 years, 3 years, 4 years, and so on. But in money market, remember very important thing, yields are annualized, which means you do it raised to 2. For example, if it's a semi-annual yield, you make it annualized, but they are not compounded. What does it mean? For example, if in the bond market, the interest rate, let's say the yield is 5%. So we do for 5% for 6 months. So what do? We generally do 1 plus 5%, annualize it. How do we annualize it? If it 5% is for 6 months, how many 6 months do you have in a year? 2. So you do raised to 2. Correct? This is what you do in a typical bond market. However, in money market, if the 6-month yield is 5%, to make it annualized, you do 12 by 6. You don't do raised to, raised to 12 by 6. You do rather simply 12 by 6 or multiply with 2. That's the biggest difference here. So both are annualized, but bond markets are compounded. Money markets yield are not compounded. Is that clear?
Yes.
Right. So in order to do YTM calculation, we generally always use the calculator function. But money market yields are difficult to put up in the calculation equation. You'll have to use a non-standard method to calculate the money market yield. Okay. So to calculate the money market yield, the methodology will be different, and that's why we will not be able to use our financial calculators in money market. We'll have to rather depend on some manual iterations. Clear? So that's what we'll say. The third biggest difference is that bond yields they use 365-day as maturities, or 365-day as the periodicity. So in 1 year, what is the assumption in bonds? In bond calculation, the assumption is 365 days in a year. But in money market instrument, it can be 365 or it can be 360 also. It can be 360 also. Is that clear?
Yes.
Now, this 360 part will be mentioned in the question, whether it's 360 or 365, that will be mentioned in the question. But tell me one thing, if you want to compare the yield of your money market instrument and that of the bond, what is the common ground at which you can compare both of them? You'll have to make both of them at one particular periodicity, right?
Yes.
Which means you'll have to compare both of them. For example, if the money market instrument is for 360 days and if the bond is for 365, then you'll have to convert the money market instrument from
360 to
365 so that it is comparable to the bonds, right?
Yes.
And this thing is called bond equivalent yield. What is a bond equivalent yield? It's a money market yield which you convert from 360 to 365. Is that clear? The name itself has the meaning. Bond equivalent yield means you have converted the yield in the manner that now it is comparable to the bond. Correct? So 360 or 365 will see the effect of that. However, we also need to see the effect of how the money markets are issued, in what terms they are issued. So the money market rates are either discount rates or add-on rates. What is discount rate and what is add-on rate? I will have to discuss that with an example. And then we will come back to the formula. For example, this particular thing, and we'll go back to what we have written here. We'll go back to that in a while. But before that, this security currently has a present value of 99. So it's issued at 99 and par is 100. The time period is 90 days. So tell me one thing, if you invest today, how much will you put in the security?
99.
And you'll get 100 on maturity. So you'll get a $1 value. Clear? It's like, you know what? That you will get $1 if you invest now, and in between you are going to get nothing because it's like a zero coupon bond. So there are three types of yield that we may be asked in the exam. The first is discount yield, the second is add-on rate, and third is a bond equivalent yield. Discount yield, the name itself says it's a discount. How much is the discount on this bond in terms of dollar?
$1.
$1 on how much
100.
dollars? On 100.
100.
Correct? So if you check out the discount, it is the discount amount is $1, and this $1 on the amount of 100, right? That's your discount amount. How do I calculate that? FV minus PV over FV. That's going to be your discount in percentage. Clear? But
Yes.
this discount is for 90 days. So how much is the annualized discount? That I will do 360 divided by 90. Is that clear? That gives me 4% as the annual discounting rate, because 1% is for 90 days. So annually it is 4%. Clear?
Yes.
Correct. So discount means how much is the discount percentage, or discount rate means how much is that discount on the bond in annualized terms. So if you do the reverse calculation, if you have the discounting rate already, you can find the price. What is the bond's par value? 100. And how much was the discount on it? It's like a tax. How much was the tax on it? It was 1%, right?
1%.
So I will do 1 minus 1%, but that 1% annually it is 4%, right? And quarterly it was 1. So 1 minus 4% is the annual discount. But then when I do it 90 by 360 to reflect it for the quarter, I'll get back the value of 99. So if you have the discount rate, you can find the price. If you have the price, you can find the discount rate. Is that clear? Just check out what I've done in the equation. So if you notice here, what I've done is that if I had the discounting rate, that is 4% annualized, I can get a price, right? And if I have the price, I can basically find the discounting rate. Clear? So how much is the discount that you get on this bond or instrument when you buy? you can say 1% for a quarter or 4% annualized. Is that
4% annual.
right? So how much did you invest? 99 and you got 1, or you invested 100 and you got 1?
100 and got 1.
No, you invested 99 now and you got $1. So you got return of $1 on your investment of 99, not 100. That's the twist. Are you getting it?
Yes.
I'll repeat. If I say that you invested 100 and you get $1, that's called add-on rate. What is that called as? Add-on rate. Add-on rate is a typical rate on a bond that you invest in the bond today, let's say $1,000, and what is the money that you will get on those $1,000. So it's above the par what you get. But zero coupon bonds or money market instruments are discount instruments. So in that, you invest the present value, which is less than par, and you get more. So it's not the rate that you get on the par. That's the difference. So here, my return is $1, but not on the par. My return is $1 on the present value, which is 99. That's the biggest difference between a discount rate and the add-on rate. This is the discount rate and add-on rate. Discount rate is calculated on face value. It just tells you how much is the discount on the bond. But add-on rate tells you that how much is the return on the bond. Well, your return is again $1, right? But on the investment of not 100, 99. Are you getting it?
Yes.
And if I annualize this, 360 divided by 90, I get an annualized return of 4.04%. This is different from the discount of 4%. Clear? The bond is available at an annualized discount of 4, but my return is more than 4 because I get that same $1 on 99 and not on 100. Is that clear?
Yes.
Correct? So do you know the time value? Do you remember the time value equation here? What is that? Our time value equation of present value and future value? We did present value into 1 plus r raised to t equals to future value, right?
Yes.
That r was your actually returns. So discount just tells you that how much is the discount you got. But yield tells you the return on your investments. Correct? Now, the only twist in money market instrument is that instead of using compounding, we are going to use the simple way of annualizing. So now I will just change this. So present value equals to something into something equals to future value. But here I am now going to put 1 plus r not raised to. I will do 1 plus r into d by 360 or 365 whatsoever. Instead of doing raised to, what is that I've done? I've used simple interest. Is that clear?
Yes.
That's what we just learned, that in bonds, you do annualize and compounding. In money market, you do multiply by the days. Clear? Everyone? So now the conclusion is what? The conclusion is here, basically, how about to put this up in the equation. So if you are given the add-on rate, you can find the present value. Well, we know the present value is 99, but how do I find it? What is the par value? 100. Divide by this equation, 1 plus r. What is 1 plus r? R is the yield on the bond, which is 4.04. But this yield for 90 days. 90 by 360. When you do divide by this, you'll almost get 99. Is that clear? Right? So how do I find the future value? You discount that, right? By the yield. Now I have done the same thing. I've discounted that by the yield, but which yield? Add-on rate. Are you getting it? Add-on rate. Why add-on rate is like a YTM. But the only difference here is in the calculation that in bonds you do compounding 1 plus R raised to T. Here you will do 1 plus R into T. Correct?
Yes.
Now, so what is the discount rate on this instrument? 4% annualized. But that discount is on $100, but your return is on 99. So your returns are slightly going to be higher than the discounting rate. That return or yield is called add-on rate. Is that clear?
Yes.
Right? Now, bond equivalent yield is add-on rate only. The only difference is that BEY is also called as add-on rate for 365 days, so that it is comparable. So basically, my entire calculation that I did on add-on rate will be the same for bond equivalent yield. The only thing I will twist is that instead of 360, I will keep the 365 days. Are you getting it? Clear? That will be slightly higher now, because I am taking 365 days in a year. Clear?
Yes.
So bond equivalent yield is nothing but add-on yield only, which is 4.404, but for 365 days instead of 360 days. So I just adjust directly the add-on rate. I'll still get the same percentage. Are you getting it? Clear? So can I say the bond equivalent yield and add-on rate are same if they both are calculated for 365 days? Correct? Everyone?
Yes.
So what is the highest thing and what is the lowest thing? If you check here carefully, discount, the highest one is bond equivalent yield, which is greater than add-on rate, which is greater than discount rate. Clear? That's the conclusion.
In the equation which you showed for the present value, the second one, present value into 1 plus R
into T.
It should be into 360 by days, right? No.
So it's into T, into the time period. If the time period is more than 1 year, then then it can be 2 multiplied by 2. Let's say if it's 2 years, then it will be, you can say 720 divided by 360. So it will be 2. But if it is less than 1 year, then I will have to do 90 by 360.
Yeah, 90 by, okay.
So it's the same time period. So let's say here in the same equation, if it was for 90 days, then my equation here would be present value into 1 plus R raised to 90 by 360 equals to future value. And here also it would be present value into 1 plus R 90 by 360 equals to future value. So outcome is going to be the same. If it's for 2 years, then 1 plus R into 2 it would be. Clear? So you have to adjust the rate with the periodicity.
Okay.
In money market, the periodicity is always going to be less than 1 year. Therefore, you need to readjust it. You need to break it down. Okay. If it's for more than 1 year, then the D will be greater than 360. Simple. Then the raise to will be greater than 1.
Okay.
In compounding. But in money market, we are doing simple interest calculation. Okay.
Yes.
So the biggest difference between discount rate and add-on rate is that discount rate is calculated on face value and then annualized. Add-on rate, it is calculated on present value and then annualized. And the difference between add-on rate and bond equivalent yield is just the adjustment of the days. You convert the add-on rate into 365, then it's bond equivalent yield. Is that clear, everyone?
Yes.
Now focus here. What are discount instruments? Discount instruments are those which are issued below par. Like T-bills, bankers acceptance. They are issued below par and most of them are based on 360 days. Okay. But add-on rates are instruments which gives you yield above the par, which gives you, so your investment is actually $100 and whatever you are going to get is above the $100. So 5% is, so on maturity, you will get 105. Okay. Now 5% it will be on 100. That's the biggest difference between add-on rate and a discount rate. Discount rates are those instruments which are issued at discount and redeemed at par. Add-on rate instruments are not issued at discount. They are issued at par, and on maturity they give you par plus the interest. Clear? So bank CDs, repos, or any instrument on LIBOR, they are all add-on rates. Is that clear? And bond equivalent yield is nothing but AOR, add-on rate, for 365 day basis. Correct?
Yes.
So now I'll take one more example through which things will be very much clear. Suppose the quoted rate for a 90-day money market discount instrument with face value of 1000 is 10%. What is the quoted rate? Means the add-on rate or the discount rate. What is it exactly? If they say the quoted rate for a money market instrument, see, check. They have asked me for bond equivalent yield. Am I correct?
Mm-hmm.
Well, if they ask me a bond equivalent yield, and if they would have given me this as an add-on rate, then the only thing I would have to do is that convert into 365, isn't it?
Yes. Correct.
So basically what they try to say here is the discount that is being offered on the instrument, that is 10%. Mm-hmm. So what is first of all the time to maturity here? The time to maturity is
90 days.
90 days, correct? The discount rate I will say is 10%. So, and the par is $1,000. So at what value this instrument would be issued? Just do the calculation without putting into the calculator. Just tell me. How much is the discount?
10%.
I just need to correct it here. The discount is, suppose that 90-day money market with the face value of 10,000 is, just need to correct one thing. So it's 10%. So now what do we need to do? 10% on $1,000. But remember, 10% is annualized and our instrument is for 90 days. So if 10% is for full year, how much would that be for 90 days? How can I calculate that? Yes.
10% into 360.
10% into, no, 10% is for 360. So it has to be
into 90 by
90 divided by 360. That should be my discounting rate. Clear?
Mm-hmm. Yes.
Now, I have the discounting rate and that discount is offered on the par. So out of 100, I will subtract this. 100 multiplied by 1 minus this. So from 100, I'll subtract a discount of 10% for full year. So technically, if you calculate, 5% is for half year and 2.5% is for 2.5% for a quarter, right?
Quarter.
So from, not par is 1000, sorry. So from 1000, if you subtract 2.5%, you'll get a value of 975. Clear?
Yes.
Okay. So an investor who invests in this bond, how much is the money that he's going to put up or she's going to put up?
975.
975, and return she'll get 1000, right? So can I say here the return is 25 on 975? Am I correct? Right?
Yes.
Multiplied with, now whether to take 360 or 365. If you have to calculate bond equivalent yield, directly put 365 divided by 90. Are you getting it? So you'll get 10.4% directly. If you do directly multiply by 365, you get a bond equivalent yield. Am I correct?
Yes.
Okay. Any questions? So here it was $1,000 instrument issued at 10% discount, annual discount, but you are issuing for 90 days. So for 90 days, the discount is 2.5%. So you get $25, but not on 1000, on 975. That's going to be your yield. And if you do it for 365 days count, then it is bond equivalent yield. Clear?
Yes.
Now, what if they just give you add-on rate and they tell you directly to convert bond equivalent yield? The only difference between both is for days, right?
Days.
So here they have given the 180-day add-on rate is quoted as 5.81%, which is on 360 days. Find bond equivalent yield. What do I need to do? What will I do? 560 this into 365 divided by 360, isn't it? Because 5.81 is for 360. So how much would be for 365? So it would be slightly higher, or I can say 5.89%. Clear? Right? It will be slightly higher for 365 days. Correct? Now, this is the yield which you can compare with the existing bonds in the market, which are actually quoted for 365. And now you can say which bond gives you better yield. So the reason that we do 365 days calculation is, unfortunately, many bonds in US are traded at 360 days. So there are few bonds which are traded at 360 days count, and most of the bonds are 365. So what you need to do, you need to convert this 360 days bond into 365 so that you can compare both of them. Correct?
Yes.
That's why it's called bond equivalent yield. So whatever is your yield on whichever days it is, it should be in 365 so that you can compare with the global bonds. Clear?
Yes.
Now, just to go back and remember the formula, remember the discounting rate is always on par. The add-on rate or the yield is always on present value. And bond equivalent yield is nothing but add-on rate, just that it is calculated on 365 days basis so that you can compare that with the other bonds. Clear? Right?
Yes.
Now that's the yields for money market instrument. We've calculated yields for fixed bonds. We've calculated yields for callable bonds. We've calculated yield for floating rate bonds. And now we calculated the yield for money market instruments, right? So basically we have calculated yield for all the types of instrument that you see here, right? So now you know how to calculate yields and prices for any type of bond. So what if I now draw a graph where I have yields for various maturities? And you know what is the maturity risk or what is the maturity effect? Can you tell me? What is the maturity effect?
Longer the maturity, the more sensitive
the yield, or lower will be the yield?
Sorry?
If the maturity is higher, the YTMs will be higher or lower? If the maturity is higher, the yields would be higher or lower? It's a simple question. For example, if I tell you to give me money for 5 years, is that riskier? Or if I tell you to give me money for 20 years, what is more riskier?
Higher. It would be higher.
That's the natural thing. So you should always remember it naturally that if I lend money to someone for 5 years, is that riskier? Or if I lend money to someone for 20 years, that is riskier. Well, giving money for someone for 20 years is more riskier.
More riskier.
Now, these days, giving for 20 days also is riskier. But the more the number of period, the more the period, the riskier it is, right? That's called maturity effect. Except one thing, in maturity effect, higher the
lower coupon,
more riskier, except for lower coupon bonds, which are slightly exceptional. Otherwise, higher maturity, higher should be the yield, right?
Yes.
Now, that's what the yield curve tells us. The yield curve, which I just showed you all, it's the yield for various maturities. So a yield curve is formed, let's say a yield curve is formed from the treasury bonds. So all the treasury bonds that I have available in the market, I just plot them, all the bonds with different maturities. I plot them on a graph, and what do I notice? I notice an important thing, that as and when the maturity of the bonds increase, their yields also increase. Is that clear?
Yes.
Is this a normal situation or not? Well, this is a normal situation. This is a normal situation. And that's why we call this type of yield, which is upward moving, that you would see here in the orange one, this type of yield, which is generally upward moving, this is what we call as normal yield curve. What is that we call as? Normal yield curve. Normal yield curve is slightly upward moving, where the longer maturity bonds have higher yield compared to the lower maturity bonds. This curve, which represents the yield and the maturities, the curve or the term structure of yield with respect to various maturities, this curve is called yield curve. Yield curve is a graphical curve which plots YTM of the bonds vis-a-vis the maturity. So for various maturity, what should be the yield or YTM on the bond? That is called the yield curve. Is that clear? The yield curve, what does it tell me? Well, it tells me where will the future interest rates be. What will happen to the future, not only interest rates, but also the economy. Okay. So what is a normal yield curve? A normal yield curve is a yield curve where dash maturity bonds have higher yield than dash maturity bonds. Fill in the blank.
Longer maturity
Bonds have
higher yield.
Yields compared to shorter maturity bonds. Is that clear?
Yes.
Now, at times what happens? That the shorter maturity bonds yields are okay. They are not moving too much. But all of a sudden, the longer maturity bonds yields have spiked. They have shot up. Why? Because there is too much of borrowing for longer maturity. Tell me one thing, if people are borrowing too much for 5 years, by the way, why do you do long-term borrowing? Why do you do a long-term borrowing? You do a short-term borrowing to manage your working capital, right?
Yes.
So why do you do long-term borrowing? Why do you borrow for 5 years, 10 years, 20 years?
If they have invested in fixed asset, like longer.
Yes. If you are investing in building up capacities, if you are investing in building up infrastructure, if you are investing in longer term projects, right?
Yes.
So tell me one thing, if for example, let's take an aircraft industry, or let's take a shipping industry. If you expect that the business of travel will increase and you are the head of an airline company, will you order for more planes, or will you order for, let's say, more ships? If you are in the shipping industry, if you expect global economy to rise, will you order more or less?
Order more.
Order more. So these planes or ships will take years to build up and many years to maintain. So you may go for, so you are basically increasing your capacity, and therefore you will require long-term loans, right?
Yes.
So all of a sudden, when long-term demand of loan is high, what will happen to the yields of long-term? They will steeply increase or fall?
Increase.
Increase. So the one on the top that you see is called steepening of the yield curve. Steepening of yield curve. What do you notice in this? In this, the short-term yields are where it is, but the long-term yields have spiked. Is that a good sign or not?
It's a good sign.
Yes, it's a good sign. It means the economy is expanding. Is that clear?
Yes.
Now comes a situation where from the normal yield curve, the yield curve is becoming flat. Flat means the short-term yield. See this. Ideally, the yield curve is like this. Try to imagine it. Right? Now the short-term yields are rising and trying to be as comparable to the long-term yields. So the long-term yields are dropping, but the short-term yields are slightly increasing. This means that there is some problem in the short-term credit market. Are you getting it? People need more money for immediate. So when a yield curve becomes flat, from normal, it becomes flat. It means that the longer maturity yields are dropping or increasing?
Dropping.
dropping, and the shorter maturity yields are
increasing.
That gray one you see, that's called flattening of the yield curve. Flattening of yield curve. I mean, bear with my spellings. Clear? So flattening of yield curve is a situation where, what is the situation here, guys? The long-term yields are falling and the short-term yields are rising. But still the long-term is higher than the shorter term, right? Now, there can happen a situation where the short-term yields have increased so much that it has gone above the long-term yields. That's called inverted yield curve. That is called
inverted yield curve.
Now, inverted yield curve is definitely a disastrous situation. Why? Because if you need money immediately, you'll have to pay too much than what you may require for even 5 or 20 or 30 years. That means all of a sudden, there is a credit crunch. There is completely lack of liquidity from the market. People are not ready to lend for short term because for immediate terms, you see money being wiped out from the market. This is what happened in 2007 financial crisis, that the short term yields just shot up when there was a credit crunch and the entire financial market collapsed. Are you getting it?
Yes.
So the conclusion here, what tells you that economic situation is bad? Steepening of yield curve or inverted yield curve? Inverted yield curve. So basically there are three types of yield curve. Normal yield curve, right, which is slightly upward sloping. If it steepens more, it's a good sign. Flattening of yield curve, where the yields are slightly falling for the longer maturity or rising for the shorter maturity. But when it turns inward, it means the economic cycle is at a bad phase. Am I clear?
Yes.
Right. Everyone clear about what is yield curve?
Yes.
Next time, if someone asks you that what's happening to the economy, don't tell them that the markets are rising or falling. Just tell them that, you know what, I think the yield curves are flattening, and you can add some accent to it and people will be really impressed. Okay. So next time when you say someone what's happening to the market, just tell them that, you know what, the yield curves are flattening and they may turn up inverted. So that's a much better answer rather than saying that, you know, the stock markets will fall. Clear?
Yes.
Okay. Now, using all these concepts, what we are now going to do is that we are now going to predict what is going to happen to the future interest rates. Remember at the start of the session, I did tell you all that probably by the end of the session, I don't know whether I told or not, that probably by the end of the session, you will be able to predict what is going to happen to the interest rates. That's what we are going to learn. And that is the calculation of forward rates from the spot rates. This concept is actually based on on a theory called pure expectation theory. Now that pure expectation theory will come in a much better way when you go in level 2, the theoretical explanation of pure expectation theory. But here, what is the spot curve? Spot curve, spot. Here, a yield curve is more like a spot curve. These are all spot. It means these are all, let's say this is one month. So this is the yield for 1 month, zero coupon yield for 1 month. For example, this is 7-year, yield is 1.32. What does it mean? That if you invest in a zero coupon bond for 7 years, you get 1.32. That's why it's called spot rate. So spot rates, especially for US Treasury, which I showed you all, is referred to as zero coupon or strip curve. Why it is called zero coupon? Because they assume US Treasury bonds, they are discount bonds. They are issued at discount and redeemed at par. So whatever is the yield, that's itself, whatever is the discount is your yield. Are you getting it? Because zero coupon bonds, US Treasury bonds are also called as stripped securities. Stripped securities. That's why they are called as strip bonds. But you remember spot curve as curve for zero coupon bonds. Is that clear? So they are also considered zero coupon YTM for bonds for every maturity. So spot rate technically means the yield if you invest from now till that point. I'll repeat, spot rate means yield if you invest from today or from now till that maturity. Is that clear?
Yes.
Right? For example, if it's a 3-year bond, and in 3-year bond, what is the discounting rate for that 3-year bond? That's your spot rate. Okay. So now I will show you how exactly we pursue it. So in a typical 3-year bond, we ideally use a single rate for discounting all the cash flows, right?
Yes.
But then we understood here in the spot rate that instead of using single rate, what should we use? We should use the rates for every maturity, right? So if it's a 1-year cash flow here, if you see in the example, we use the 1-year spot rate. If it's if the cash flow is in the 2nd year, we did use the 2-year spot rate, 3-year spot rate, and 4-year spot rate. So what are these spot rates? Everyone, these spot rates are the discounting rate for that particular period. Am I clear or not?
Yes.
Right. Now, in the spot rate year, what was the value of the bond? 100.
100.
But I remember I told you that it will not always be 100. And that's why in the next bond, you got 110.52. You remember that?
Yes.
Now, if it turns to be 100, if the present value turns to be 100, then these discounting rates are called par rate. Are you getting it? So your doubt itself is getting into a solution. If the discounting rate are such that the present value becomes 100, if you see here, if the discounting rates are such that the present value becomes 100, then it is called as par rate. And if you make a curve of all these rates, it is called a par curve. Is that clear?
Yes.
So a par bond yield curve or a par curve is the yield that reflects the coupon rate. Why coupon rate? Because what happens to the par bonds? The yield and coupons are
Equal.
Equal. So when I say this is called the par rate, you can also say that this is also the coupon rate, because for a par bond, the coupon and YTM are same. Clear?
Yes.
So if I say a 3-year par rate is 5%, it also means that if you want to issue a 3-year bond, you can keep a coupon of 5%. Clear?
Yes.
Now, this par curve can also be constructed from the spot curve. This par curve can also be constructed from the spot curve. We will see that, right? But our objective here is majorly going to find out what are going to be the future interest rates. That's called the forward rates. So forward rates are basically the rate for which, let's say you are going to borrow or lend not now, but after 1 year. After 1 year. For a period of, let's say, another year. So if I'm going to borrow for 1 year after 1 year, let's say if I'm going to borrow for 1 year after 1 year, I'll write it down here. If I want to borrow immediately for 1 year, I have no problem, because I can just go to the bank and ask what is the rates, right? So ideally, bank would give me which rates? Bank would give me the rates of 1 year deposit or borrowing from now, correct? And banks could give me the deposit or borrowing rate for 2 years from now. Clear?
Yes.
But will the banks give you the rate for 1 year after 1 year?
No.
No. So if I go and ask the bank, what is the rate between 1 and 2? Between 1 and 2 means 1 year rate after 1 year. It's called 1Y, 1Y. What is 1Y, 1Y? It's a 1 year rate after 1 year. That's called the forward rate. Is that clear? Right? Now, forward rate. How do I calculate the forward rate? Well, calculating forward rate is like traveling. Calculating forward rate is like traveling. So tell me any two cities in your place which you frequently travel, two big cities that you frequently probably, or you travel for a long trip. Any two cities, can you tell me?
For me, it is Vancouver and Edmonton.
Okay, so you Vancouver and Edmonton, right?
Edmonton, yeah.
And you start from Calgary.
Yes.
So what comes first? I mean, between, let's say you start from
Edmonton.
Calgary to Vancouver, right? So is there any stop in between? Like Edmonton is between Calgary and Vancouver?
No, it's not. It's two different.
So let's say you go from Calgary to Vancouver. Is there any stop in between? That
Lake Louise. Yeah.
Okay.
Banff. You can say Banff.
Can you spell it?
BANFF.
Bath. Okay.
Yeah.
Is it a German oriented city or what?
No, not really.
Okay. So here you are at Calgary, right? And then in between you have this Banff.
Banff. Yes.
And you want to reach to Vancouver, right? Now, you know the distance from Calgary to Vancouver. You know the distance from Calgary to Banff. Then, can you not find the distance, the missing distance between Banff and Vancouver?
Yes.
Right? Now, just see the same way. If I have the spot rate starting from today for 1 year, from today till 2 years, can I not find the missing link?
Yes.
That the forward rate after 1 year for another year. That's called the pure expectation theory. Is that clear?
Yes.
That's what we are going to now do. So this can be applied to any maturity. For example, now see this. There are some techniques that I will be using and I would want you all to focus with me. For example, they use this terminology or this notation called 1Y, 2Y or 2Y, 5Y. Now, what I tell all my students is to read this in Arabic form. Where do you start in Arabic from? From the left or from the right? When you write the Arabic, do you start from the left or from the right?
Left.
Start it from the right.
Right.
Normally start writing from the left, right?
Left. Yeah.
But in Arabic, you start
Arabic
from the right.
Yeah.
So read it in that way. 2Y, 1Y is 2-year rate after 1 year. How do you read it? From the right. 2-year rate after 1 year. So after 1 year means this 0 and 1. After 1 year, rate for 2 more years. So this is actually 3. Are you getting it? Clear? So now read this. This is a 2-year rate after 1 year from today. Is that clear?
Yes.
So how do I read 2Y, 5Y? 2Y, 5Y. It's 5-year rate after 2 years. So 0, 2 and another 5 year. So if I take this 5 year, where would that end? 7th year. Is that clear? So it's a 5-year rate after 2 years from today. Clear?
Yes.
Now, in order to find this 5-year, I need the spot rate for 2 years and I need the spot rate for 7 years. Only then I can find the 5-year rate. Is that clear? that forward rate is going to be my expectation. It's not going to be for sure, but that's going to be my prediction or expectation or estimation. That's why they are called as expected forward rate, or they are called as implied forward rates. Is that clear? So implied forward rate or expected forward rate, these are the forward rates that you and I are predicting would happen based on the spot rates. Clear? Now, let's see that. How do we put? But what if I find the forward rates in this manner for every maturity? Let's say I find the forward rate after 1 year, after 2 years, after 3 years, and after 4 years, and for all the maturities. And then I make a curve of all these forward rates. Then it's called a forward curve. Like you have spot curve of spot rates. But from the spot rates, if you find the forward rates, you can make a forward curve. Clear? Right? So let's try to now find solution. Very, very interesting. Suppose the following yields to maturity are available for government bond. These bonds are zero coupon bonds. So they have given me 1 year, 2 year, and 3 year yields. Now, what are these yields? What are these? What are the types of these yields? Like, are they, what exactly are they? Spot, forward, what exactly are they? Can you just identify? These are zero coupon bond yields. Means, what are zero coupon bond yields? Spot. So they have given you the spot rate for 1 year, 2 year, and 3 year. What is the 1 year spot rate, guys?
1.8992.
Clear. And then they've given for 2 years, and then they've also given you for 3 years. So I have got the 1 year rate as 1.8992%. The 2 year one is 2.5433%. And the 3 year is 2.9994%. Now, if I have the spot rates, can I not find the area between that?
Yes.
So what is that they have asked me in first part? In first part, they've asked me, in the first part, they've asked me 1Y, 1Y. What is 1Y, 1Y? Can you tell me?
1 year rate after 1 year.
1 year rate after 1 year from today, right?
Yes.
Now, in order to find this, what do I need? I need for 1 year after 1 year. See this. I ideally need, I need not draw the diagram again, but just for your
1 year and the 2 year spot rates.
Yes. So ideally, I'm looking for this period, right? Between 1 and 2. For that, I need the spot rate starting from today. That is from Calgary to BAF. And then I need another distance starting from today till 2 years, which is I need the distance from Calgary to Vancouver. Yes. Then I will get the distance between BAF and Vancouver. Clear?
Yes.
So now there is a way of doing it. But before I show you an actual way, I will show you an approximate way. Approximate way is just for your reference, not to be used in exam. Okay. Mm-hmm. What is the approximate way? Let me show you the approximate way. I'll repeat, approximate way is just for your reference, not to be used in exam. First of all, what is the 1 year yield? 1 year yield is 1.8992%, right? And how about the 2 year yield? The 2 year yield is the 2 year yield. Yes.
2.5433.
Yes, it's 2.5433. So if you invest for 2 years, let's do a simple mathematics. You'll get 2.5433 every year. Correct. So yes. Basically, your returns will be into 2. Correct. Which is just, I'll just put it here into 2 to make it simple. So it's going to be 5.0866. Clear? Now, so if you do the calculation from this, so for 2 years, you get 5%. For 1 year, you get 1.89. So what is the missing? Well, you can do 5.0866 minus 1.8992. That should be approximately your 1y. Are you getting it?
Yes.
But how to exactly do this? Now let me show you how to exactly find it. So now we are going to find it the actual way. The actual way is slightly interesting because it's going to be more of compounding. So we will do 1 plus, what is the 1 year yield year? 1.8992%, right? That's for 1 year. Multiply that with the second part. What is the second part? The second part is 1 plus 1y for 1 year. So now look at the gap year. Let's say you invest for 1 year from now. How much you will get? 1.8992%. Then you continue it for another year. Then how much you will get? 1y. That amount should be equal to the amount had you invested for 2 years. What is your 2-year yield? 1 plus 2.5433%. Are you getting it? But for 2 years, so raised to 2. Is that clear?
Yes.
So had you invested $1 for 2 entire years, or you invest $1 for 1 year and then reinvest for another year. That's the equation I've used. Clear? Now, if you solve this directly, you can directly put everything into your calculator. Let me tell you how. So if you want to directly find this in the calculator, with me in your calculator, just put this 2.5433% first. So how will you do? 2.5433% plus 1 and then square it. Clear? Right? I hope you've got on your calculator 1.0515.
Yes.
Now this is on the right side. On the left side, this is the equation, which if it goes on the right side, it will be divided. So divide by 1.018992. What do you get on your screen? You get 1.03, right? Minus 1, because here you have 1 plus 1y. If the 1 goes on the other side, it will be minus. So minus 1 and multiply with 100, you will get an answer of 3.1914, or you can say 15. Clear?
Yes.
Now, this is very close to what we found approximately. So the approximation is for your easy reference, but the advantage of that is that you do not get too much deviated from the actual. That's why we calculate the approximate. Is that clear?
Yes.
In exam, you can directly find the actual way if you are comfortable. The intention of mine is to just tell you that you don't deviate too much in the wake of calculation. That's why I also show you the approximate way. But examiners are not going to accept this. You have to actually calculate this as the rate. Clear? Everyone?
Yes.
Now, in the same manner, what if I find the second one? What is the second situation? The second situation is 2y, 1y. Now, read it in the Arabic form. It is 1 year rate after 2 years. So, how about my timeline? Now, again, what all I need? I need 1 year rate after 2 years, right? So after 2 years, 1 more year. So I need the distance between 2 and 3. For that, I need to have the spot rate for 2 years and the spot rate for 3 years. Am I correct?
Yes.
So anyone who invests for let's say 2 year from today, that is 2y 0y, I can say. What is 2y 0y? 0 starting from today for, sorry, I don't have to write 2y 0y. I will have to write 2-year rate starting from today. Correct? So what is 0y 2y, or simply say what is the 2-year spot rate? It is the 2-year yield starting from today. Am I correct? And what is the remaining part? The remaining part is 1-year rate after 2 years should be equal to the 3-year rate from today. So this also can be said as spot for 2 years and spot for 3 years. So if we have spot for 2 years and spot for 3 years, you can find the missing link. Am I correct?
Yes.
Now let's try to do the same technique here. I'll just multiply to make it easier. What is the 2-year rate? You have the 2-year rate with you, right? Which is 2.5433. Multiply with 2 because it's a 2-year rate. Now what is the 3-year rate? The 3-year rate you are given here is 2.994. Am I correct?
Yes. So
if I take that 2.994, and since it's a 3-year rate, I'll multiply with 3. I get 8.992%. 9982%. Correct? Now, if I use this and subtract this from 5.0866, what I would get is 3.9916%. That's going to be my yield for 1 year after 2 years. Is that clear? Approximately. Correct? Now, but in order to put this in a compounding equation, you have to be careful here. What is your 2-year yield? What is your 2-year yield from today? For example, how will you have to pursue this? If you invest for 2 years from now, how much will you get? 1 plus
2.5433 raised to 2.
5433% raised to 2. That's for the 2 years, right? Yes. Then you will continue again for 1 more year.
Yes.
So how will you do that? You will do 1 plus, you'll do 1 plus 2y, 1y.
1y.
Raised to 1. Why raised to 1? Because that's only for 1 year.
For 1 year.
Correct? This should be equal to the 3-year rate. What is the 3-year rate? 1 plus 2.9994% raised to 3. That should be your equation. Is that clear?
Yes.
Now, even I can solve this directly. Even this can be solved directly. See this. 2y, 1y. Just see that everything else should be on the other side. So first, what you will do with me is that you will calculate this part. So let's do it. 2.9994% plus 1 raised to 3. Let me know what do you get on your calculator. You must be getting 1.0927, right?
Yes.
Now store it. Store 1. Now on the left hand side, what do you see? 2.5433% plus 1 and square it. So you'll get 1.0515. Correct? Are you getting it? Let me know. Yes? Yes or no, everyone? The first one, 1 plus 2. So do 2.5433% plus 1, square it. This is what we did in the previous one also.
Yes.
Right? You'll get 1.0515. Store it. Store 2.
Okay.
Now press recall 1, divide by recall 2, and then minus 1, and then multiply with 100. You'll get 3.917. Am I correct? Approximately.
Yes.
You get 3. 917,695. So I'll write 77. Clear? Right? If you are comfortable directly with the actual way, you can skip the approximate way. Okay? Approximate way is just for your reference. If you're comfortable with the second method that I've showed, which you actually have to do in exam, you're free to skip the approximate way. Clear? So now if I go to the diagram here, the main one, I can fill up the future rates. So if someone wants to invest for 1 year from today, what is the rate? Someone wants to invest for 1 year from today, invest or borrow for 1 year from today. What is the rate? What is the rate?
3.
It's 1.8992 from today, 1 year from today.
1 year, okay, 1.8992.
Right? But if
Yes.
you delay it, if you invest after 1 year for 1 year, what is the rate that we've got?
3.1915.
3.1915. And if you delay for 2 years, then the rate is
3.9177.
So what is happening? Are the rates increasing or decreasing?
Increasing.
Increasing. This gives you an idea to consult your CFO that, sir, if you are planning to borrow, we should not delay. Otherwise, the rates are going to be increasing. Clear? But if you're planning to invest, if you delay, you may probably get more returns. Correct? This is how you can use, this is just one example. This is how you can predict the interest rates and apply that for your decisions. Is that clear?
Yes.
So a very important thing here is that if you have the spot rates available, you can predict the forward rates. So for example, in the yield curve that I showed you, if I have the spot rate for 5 years and if I have the spot rate for 7 years, I can actually predict the 2-year rate after 5 years. I'll repeat. If I have the spot rate for 5 years here, and if I have the spot rate for, let's say, 7 years, I can predict what is going to be the 2-year interest rate after 5 years.
Yes.
And by that way of prediction, I can tell someone that what is going to be the interest rate after 5 years based on what is the situation expected by the traders now. Correct? Right? Do you want to calculate this quickly? Should I show you? I don't want it to be complicated, but let me quickly show you. What is the 5-year rate that you see for treasuries?
0.86.
86%, right? Raised to 5.
Raised to 5.
That you should multiply with 1 plus, I should say it's a 2-year rate after 5 years.
After 5 years.
But since it's 2 years, you should do raised to 2.
Raised to 2. Yes.
Should be equal to 7-year rate. What is the 7-year rate? 1.3% raised to 7.
Raised to 7.
Okay. Now, if you calculate this in your calculator, let's do it together. So 1.32% plus 1 raised to 7 and store it. Store 1.
Mm-hmm.
Then do 0.86% plus 1 raised to 5 and store 2. So you'll have recall 1 as 1.096 and recall 2 as 1.043, right?
Yes.
Now do recall 1 divide by recall 2. Clear?
Yes.
But remember, on the left hand side, it is square. So on the right hand side, yes, it should be square root. So now press square root. Do -1 and multiply that with 100. You'll get 2.479, or you can say 2.48.
Yes.
So my answer will be 2.48%. This is the way you can tell someone that, do you know what? I think after 5 years, the 2-year rate will be 2.48%. This is called astrology. And I'm not kidding. This is the fact. So if someone tells you, can you tell me what will be the interest rates in the future? Yes, I can tell you from the spot rates now. Clear? Got it?
Yes.
So that's a very, very interesting thing or interesting way to know things. Now, if I use this thing in the calculation of bonds, do you know how did we use the spot rate to calculate or find the value of the bonds? How did we use the spot rate to find the value of the bonds? We had the cash flows for every maturity, and then we discounted that with the spot rate. For example, for second year, we discounted with the 2-year spot rate. Now, instead of 2 years, can I not use 1-year rate and 1-year forward rate? Both? I can use it, right?
Yes.
Instead of 2 year, if I don't have the 2-year spot rate, I can use 1-year spot rate and 1-year forward after 1 year. That's going to be the same thing, isn't it?
Yes.
Right. So now we will use this concept of pure expectation theory in finding out the value of the bond in the same manner that we've done. Okay. Let's see that. But before that, let me just do some easy calculation with you so that we become sure that we've understood the calculation of forward rates. So suppose an investor has 2-year investment horizon and has 2 options. So how much time period you want to invest? You want to invest for
2 years.
2 years, right? So what are the normal choice you have? The normal choice is that you invest in a 2-year bond, right? Or you invest in a 1-year bond and then reinvest for another year after 1 year, right?
Yes.
I'll repeat. What are the 2 choices generally you have? The 2 choices generally you have is that you invest directly in a 2-year bond so that you don't have to be worried, or you invest in a 1-year bond from now and then reinvest that for another year. That is 1Y. Am I correct? Right? They both should give you the same yield ideally. Clear?
Yes.
So they've said me that the spot rate for 1 year is 5%. So I'll write 1 year yield is 5%. And the spot rate for 2 years. So they've given me the spot rate for 2 years is 6%. So can I not find from that the missing one? What is the missing one that I'm looking for? I'm looking for 1-year rate after 1 year.
After 1 year.
So they've said that if the investor chooses the second option is, the first option is invest in a 2-year zero coupon bond, right? Which will give you 6%, right?
6%.
The second option is invest in 1-year zero coupon bond and then reinvest in another 1-year bond after 1 year. But for that, I need 1Y, correct?
Yes.
So they've said if the investor chooses the second option, what is the minimum yield she expects on a 1-year bond after 1 year? So basically they are asking me to calculate 1Y. Clear? Which is 1 year yield after 1 year, or 1-year rate after 1 year from today. Is that clear? Correct. Now, can you tell me what is the equation for this? What do you, instead of going to approximate, you can directly find it.
1 plus
5%. That's for 1 year. So raised to
1 year.
Multiply with 1 plus
1
1
year after 1.
Should be equal to 1 plus 6%
square.
Clear? So now it will be easier for you to calculate. Let me know your answer. (1.06 square divided by 1.05 minus 1, you'll get almost 7%.
Yes, 7%.
Right? And if you see the simple arithmetic average of 5 and 7, just take the average of 5 and 7, you'll get 6. Correct?
Yes.
That's how it is. It's a simple way of doing it. Now you are aware how to find forward rates from the spot rates. And as I said previously, we had done the valuation of bond using the spot rates. Now we'll do the valuation of bond using the forward rates. Let's see that. So here in the next example, they've said that the present value of the bond, you have to find the present value of the bond. Now the par is 1000, coupon is 10% paid annually, maturity is 3 years. 1 year spot is given to you. First of all, can you help me with the timeline? What is given and what is not given? I need to first plot the timeline. Timeline is like my lifeline. Yes. What are the rates given to you?
1 year, after 1 year?
First of all, you are given 1 year spot rate.
Yes, 1 year spot rate.
Which is how much? 1 year
4%.
spot rate given to you is 4%, right? And then you are given 1 year rate after 1 year. So you are given the forward rates for 1 year after 1 year. And then you are also given 1 year rate after 2 years.
2 years.
So basically you are given all the forward rates. So I will write this. The first year is spot rate is 4%, right? The spot rate is, just correct it here. Just make the spot rate 3%. Sorry. Just make the spot rate 3%. So the spot rate here is 3%. The 1 year forward after 1 year is 4%. And the 1 year forward after 2 years is 5%. Is that clear?
Yes.
So now how do I find the present value of the bond? How do I find the present value of the bond? You know, if you invest in the bond, what is going to be your coupon in the first year?
100.
Yes, coupon will be 100, correct? In the second year also, you'll get 100. And in the third year, because it's a 3-year bond, you'll get 1100. Am I correct?
Yes.
All this, ideally, I have to discount with the spot rates or
Spot
with
rate.
with generally the, whatever the discounting rates I have. Now, if you don't have the spot rates, you can use the forward rate. For 1 year, it's the same thing. So I will use 1.03, correct, for first cash flow. How about for the second cash flow? Ideally, we need a 2-year spot rate, right? But if you don't have 2-year spot rate, can I say the 2-year spot rate is equal to 1 year rate and 1 year forward after 1 year?
Yes.
So I will use 1.03, multiply that with 1.04.
0.04.
And then how about for the third one? I will use 1.03, multiply that with 1 year forward after 1 year, that is 1.04, multiply that with 1 year forward rate after 2 years, which is 1.05. Am I clear?
Yes.
Right? First of all, you should be comfortable with this equation. Then I will tell you what to do. First, get comfortable with this equation. Then I will show you the calculation. You know our technique of time value, right? Timeline, equation, and then calculation. So first timeline, then you should be comfortable with equation. Then I will show you the calculation. Is that clear? Are you have you put this equation? Yes. Let me know once you've put, then I will show you the calculation.
Yes.
So now, in order to do this calculation easy and quick, you have to follow me. So with me, put in your calculator 100 divided by 1.03. That's the first equation. And tell me what's on your screen.
97.08.
Store it. Put that store one. Now, see an idea. Already 100 divided by 1.03 is in your screen, right? On your screen, correct?
Yes.
You just need to again divide by 1.04. That's in the denominator. So on your screen, it's 97.08. Just divide it by 1.04. You'll get 93.35 and store 2. You don't have to repeat the entire process because that was already there in your calculator. Got it? Clear?
Yes.
Now there's always another way of doing it completely again, but I would just want to avoid it. Now in the third one, it's slightly tricky. Are you ready? In the third one, what is the difference? First, check in the denominator. You need to again divide it by 1.05, right? So divide it by 1.05 first. You'll have on your screen 88.9.
Yes.
But in the numerator, you don't want 100. You want 1100.
1100.
So how to erase the numerator? First, to remove 100, divide it by 100. Divide it by 100. And then multiply it with 1100. What do you have on your screen? 977.9.
977.986.
Store 3. Put that store 3. Now add recall 1 and recall 2. And let me know what is the value you have.
1168.42.
1168.42. That's the correct value. Got it? That's the correct value. Clear? So you just keep on adding, adjusting the previous equation, or there is an altogether way of repeating everything. Clear? Now, what's the difference between this sum and the one we did during the spot rate? It's just that instead of using the spot rate, you split that into spot rate for 1 year and forward rate of 1 year after 1 year. So instead of using spot, you use the forward rate. That's the only difference. Clear? Right? Makes sense?
Yes.
So now comes an interesting thing. I'm adding a twist here. Okay. What's the twist? You'll have to catch up. But before that, let me just reiterate the timeline here. It's almost the same, but minor change. And then I will put up the equation also. I'll just copy it for my simplicity. However, you can just put it your way. So here in the second one, the next question, find the present value of the bond given the following forward rates. Now, what's the unique thing about the forward rates here?
Semi-annual.
They are all semi-annual. So what are the forward rates? The first one they are given is for 6 months from today, correct?
Yes.
So I will write it 0. Then I will write it 6 months. Then I will write 12 months and then 18 months, right? Correct. Why 18 months? Because the bond is for 1.5 years, isn't it? What is the 6 month rate?
4%.
4%. What is the 6 month rate after 6 months? It's 5%. Check on the question here. And what is the 6 month after 12 months? It is 6%. 6%. Clear?
Yes.
The bond is par 100. You can keep it 1000 for your simplicity. The coupon is now 6%. But remember, 6% is the coupon for entire year. How much would be for half year?
3%.
That is $30. Am I correct? So this bond will be like $30, and maturity it will be 1030. Is that clear?
Yes.
Now, interesting thing about the discounting rate. What is the 6 month discounting rate? Carefully.
Four divided by 2.
Very good. 4 divided by 2, because 4 is annualized. For half year, it is going to be divided by 2. So I will do 1.02. Am I correct? And how about the other 6 months? 5%. You'll do 5 divided by 2, which is 2.5.
2.5.
Clear?
Yes.
So that's going to be 1.025. So I will now have 1.02 for the first 6 months, then 1.025 for the next 6 months, and then you have 6%. So half of that is 3%. Is that clear? Correct? Makes sense?
Yes.
Now, can you put that into the calculation? Very interesting thing. What will be the first thing that I will put? 30 divided by 1.02. 29.41, store 1. Okay. What's this one small thing that I need to do?
Divide by
1.025.
1.0.
The second one. You'll have 28.69, store 2. Right? Now, when you go to the third equation, check it. Divided by 1.03, that's in the denominator. But you have to remove 30. So what will you do? Divide by 30, multiply with 1030. You'll have 956.48. Got it? Divide by 30, multiply with what is there in the numerator, 1030. You'll have 956.48, store 3. Now add recall 1 and recall 2 to that. You'll get 1014.58.
59. Yes.
1014.58. Something, right? 59. Clear?
Yes.
Now you know how to find the present value of the bond with single rate, with spot rates, and with forward rates. And you also know how to predict the forward rates from the spot rates. Correct?
Yes.
This is the most fascinating and interesting thing about bonds. Clear? Any questions? Remember our technique, TEC, timeline, equation, and then calculation. So here, if you notice, this is a very crucial part. From the spot rates, you calculated the forward rates. Using those forward rates or spot rates, you can find the present value of the bond. So entire, from the scratch, you did how to value the bonds. For those bonds, how to predict the yields, how to get the yields from the treasury yield curve, everything. Is that clear?
Yes.
So now if you check the index, we are done with the yield curves. We did different types of yield curves, inverted, flattening, steepening. Then we discussed spot and forward rates. And we use that spot and forward rates to value the bonds. Now we are at the last section of this topic, that is yield spread. A very small discussion. Spread, by the way, what is spread? The first thing that comes to your mind, spread means? It's a difference. It's a difference between YTM of, let's say, a corporate bond and a treasury bond. Which one is riskier, corporate bond or a treasury bond?
Corporate bond.
Corporate bond. So let's say the YTM of the corporate bond is 5% and the YTM of a treasury bond is 4%. So the difference, or so-called as a spread, is 1%. This spread represents the credit risk in the bond. Why? Because that's the only difference between the two bonds, right? Of course, that's a major difference. But a government or the benchmark security is generally a treasury bond, which is risk-free. Clear? And contrary to that, the one that you're looking for may be a corporate bond, which is the riskier bond. And the difference between both is called the spread, which is due to the risk. So higher the risk, higher will be the spread, or narrower, lower will be the spread. Higher the risk of the bond, what will happen? The spreads will be higher. Is that clear? So tell me one thing, if the spreads are widening, that means the bond is becoming riskier or less riskier?
Riskier.
It's becoming riskier. And when the spreads are narrowing, we say the bond is becoming
less riskier.
Less riskier. Clear? So here, two things we are going to compare. Is that a corporate bond or the bond that you're looking for, and the benchmark bond, which is the risk-free rate. Now, so when I say the corporate bonds yield is 5%, it consists of two things. One is the risk-free rate plus the risk premium. One is the risk-free rate plus the risk premium. For example, when I say the yield on the corporate bond is 5%, it is actually a combination of two things, 4% plus 1%. This 4% is the risk-free return, which should be there on all the bonds. Sorry. 4% should be the risk-free rate, which should be on all the bonds. That's because all the bonds have same impact of the market. Do you know that there are two types of risk in any security? Systematic and non-systematic risk. Have you heard about it?
Yes.
Systematic and unsystematic or non-systematic risk.
Yes.
What does it mean? That let's say you pick up any particular stock. Let's say you pick up a stock of Tesla Motors. You know, there are two things which can affect Tesla. One is the macroeconomic environment. That macroeconomic environment will affect not only Tesla, but everyone, right? That's called the benchmark risk, or that's called the systematic risk, because that will not only affect Tesla, but it will also affect GM. It will also affect, the other BMW. It will also affect Volkswagen. If the economic cycle is not going through a great run, then all the car companies will be affected, right? That's called the benchmark, or that's called the yield due to benchmark. But then there are companies' internal factors due to which the company is more or less riskier. That's the extra return which you expect from the particular security. And that's the spread, or that's called the premium. Now that is because of not the macro factors, but because of the micro factors of the company. So whenever I pick up any particular securities yield, there are two components in that yield. One is because of the risk-free or the benchmark, which will affect not only my bond, but will it affect only my bond?
No.
It will affect all the bonds.
All the bonds.
So that's why the benchmark for all the bond is the same. Clear? That is the treasuries. But then the spread for all the bond may not be the same, because that depends on the micro factors, that is the factors specific to the company. Correct?
Yes.
Therefore, yield spreads over the benchmark are component of two things: the benchmark, which captures the macroeconomic factor, and the spread, which captures the micro factor, right? It is the micro factor which will decide the spread. If the micro factors are strong, the spreads will be less. If the micro factors are weak, the spreads will be higher. And these micro factors are very well gauged by the credit rating companies. Is that clear? That's the job of credit rating agencies. So this spread over the benchmark, keeps on increasing with maturity. So what is yield curve? Yield curve means a curve which measures yield with maturity, right? Now,
yes.
Instead of yield, what if I put yield curve with maturity? Instead of yield, if I put yield curve with maturity, then it's called the yield, it's called the credit curve, or it's called the benchmark yield curve, or it's called the spread curve. It has different names. But instead of yield curve, what have I put instead of ITM? I've put the credit spread or the spreads. So when I replace the yield with the spreads, that yield curve becomes the credit curve. Is that clear? Correct. I'll repeat. When I replace the yield with the yield spreads, that becomes the credit curve. Clear? Everyone?
Yes.
Now, there are various types of spreads. Not only one spread, there are various types of spread. The first one is called G spread. G means government. So here you are going to compare the YTM on your bond with the government yield, which is the treasury bonds in US. Is this going to be positive or negative? it's always going to be positive. Why? Because the yields on any bond which will be any bond will be higher than the yields on government bond. Clear?
Yes.
So G spread, the name itself says yield on government bonds. Your benchmark is going to be government bonds. Correct? This tells you the credit risk between your bonds and compared to the risk-free security. Correct? Easy. The second spread is I spread. I spread is also called as interpolated spread. Why is it called interpolated spread? This is the yield spread of a specific bond over the standard swap rate. Now, swaps are derivative contracts, which are contracts where you exchange fixed to floating. Now, you can actually go to my YouTube channel and I've uploaded a video on what is swaps, and we'll be doing swaps in detail in derivatives, not now. But just for your reference, swap rate is the rate at which banks or any particular, let's say there are two banks and they both borrow with each other. So one bank pays fixed rate, another bank pays it floating rate. So it's like, let's say I will pay you a fixed rate, in return you will give me a floating rate, right? So the fixed rate that you and I agree to share for the floating rate, that's called the swap rate. I'll repeat, I'll give you a fixed rate, in return you'll give me floating rates. So the fixed rate that we decide, it's called the swap rate. Now that fixed rate is decided by the borrowers. Let's say the international banks, they decide what will be that fixed rate. Then that they depend on the demand and supply. So actually the swap rate is more like a rate between banks or between borrowers. Okay. When you compare that with your YTM on your bond with, instead of government spread, government yield, if you compare that with the spot rate, that's called I spread. So the yield spread for a specific bond over the standard swaps rate in the same currency with the same maturity is called the I spread or interpolated spread. So here I'm going to compare the YTM on my bond with not the government bond, but with the swap rate, and swap rates are slightly riskier than government bonds. Why? Because what is considered safer, government bonds or bank borrowings? Like, who has much better credibility, the governments or the banks? Government, because they can never default, right? Because they have the magic wand of currency printing machine. Clear? So when I compare my bonds YTM with the government spread, it's called G spread. When I compare that with the swap rate, it's called I spread. Clear? Right?
Yes.
Then similar to I spread, there is called LIBOR spread. Now LIBOR is the borrowing and is the borrowing between banks in the global market, especially focusing to London market. So LIBOR is the borrowing between banks in the global market, right? So LIBOR spread is a spread where you're going to compare the LIBOR rate. For example, let's say two banks. Let's pick up any two banks. For example, Barclays and let me pick UBS, a Swiss bank. So the rate at which Barclays and UBS may borrow from each other in the London market or in the global market, that's called LIBOR, correct? However, when you compare that rate with the overnight index swap rate, what is overnight index swap rate? It's the rate at which banks borrow from each other in the US market. LIBOR is the interbank rate in the global market, whereas OIS is the overnight index swap is the interbank rate in the interbank rate in the US market. So think from a US citizen point of view, you have the interbank rate of US markets, and you have the interbank rate of global markets. Okay, so investor calculate this spread to understand which part of the world is riskier, or how much is the risk in the banking sector. So see this, investors use LIBOR spread as a measure of credit risk in the banking sector. So what does it signal? Well, it tells me that LIBOR OI spread, it's a useful measure, as I said, for credit risk, but a low spread. If the spread is low, it means that the difference between borrowing between banks in US or in globe is not different. It's almost the same. So a low LIBOR OI spread is a sign of high market liquidity. But if the spreads are widening, it means people trust less of, you can say, LIBOR banks, and they trust more of US banks. Okay. Ironically, the case is that US banks have defaulted, like Lehman Brothers in 2007, and it was a completely weird scenario where the US banks had become more riskier than the European banks. Okay. So what is LIBOR rate? It is an interbank rate between global banks, right? Or in global market. And OIS rate is then interbank rate in US. Correct? So I'll repeat, a low LIBOR OIS spread is a sign of high market liquidity, whereas the high rate is a sign that banks are unwilling to lend each other. So when this spread is increasing, it tells me that what is the scenario with the banking sector? Are the banks willing to lend each other or not? If this LIBOR OI spread is increasing, that means banks are really worried. If they are not lending to each other, that means they are gauging something very disastrous to happen in the market. Clear? So G spread is the yield on a corporate bond and government bond or treasury yield. I spread is the yield on a corporate bond compared with the swap rate, right? And LIBOR OI spread is not the yield on corporate bond, it's the yield on, or you can say it's the interbank rate in global market compared to interbank rate in US market. It tells you the risk in the banking sector. Is that clear? Right? Any questions?
Will the G spread be higher than the I spread?
Possible. No, just hold on a moment. G spread be higher than the I spread. Okay. First of all, what is G spread? It's a white time on your bond and treasury yield. What is higher, treasury yield or swap rate? Swap rates are higher, right?
Swap rates are higher, yes.
Correct. So if you see your corporate bond is yield is 5%, treasury yield is 3%, then the swap rate will be 4%. Just example, hypothetical.
Okay. Yeah, it will
So
be higher than the corporate.
Spread will be 1% and G spread will be 2%. So at any time, your G spread is going to be higher than your I spread.
Higher. Okay.
Right? Because from risk-free, you are comparing the risk. Swap rate is a risky rate, by the way. It's not a risk-free rate.
Yes.
Okay. Now, there is one last spread that is called Z spread or zero volatility spread. A very, very, very interesting, concept, and one of my favorite concepts, because this gives you a very good idea about what's happening in the market, especially when you compare the G spread and I spread. What G spread and I spread tell you? They're both going to be the discounting rates, right? For your bond. If you use G spread and I spread, they both use the same discounting rate for all maturity. So when I say the G spread is 5% for my bond, I'm assuming whether G spread or I spread or let's say the YTM, they all have the same problem. They assume that every year, it's a 5-year bond, and if the yield for 5 years is, let's say, 8%, it assumes that you'll get 8% every year, right? So if you focus on G spread and I spread, each use the same discounting rate for all the cash flows. But Z spread or Z spread uses a constant yield spread over a government spot trade, which is known as zero volatility spread. Now, tell me one thing. If you look at the yield curve here, if I'm using if I'm let's say I'm finding the present value of a 5-year bond, can I use these discount rates? I have the discounting rates for all the 5 years, right? Can I use all the 5-year spot rates, 1 year, 2 year, 3 year, and 4 year? Yes, I can use it.
Yes.
But are they not supposed to be used only for a risk-free bond? Correct?
Yes.
How about for a risky bond? Should a risky bond be discounted by the risk-free rate?
No.
It should be discounted slightly higher, right? Correct? So now, what if I discount a bond, a corporate bond, with the spot rate from treasury, but I also add the risk? For example, let's say for 1 year, I add a risk. For 2 year, I add a risk. For 3 year, I add a risk. For 5 year, I add a risk. This risk is called Z spread. Why am I adding the risk? Because I'm finding the value of not a risk-free bond, a risky bond. Can I discount a risk-free bond, a risky bond with the risk-free rate? No. I need to add some spread over the risk-free rate. That's called Z spread. And why is it called Z spread? Because I assume the spread is constant. That's why it's called zero volatility spread. Volatility means change, right? If there is no change, we assume the spread has to be constant. So we discount the cash flows of the bond with the spot rate, and the spot rate I got from treasury bond. But is it appropriate to discount a corporate bond with just treasury yield? No. Therefore, what do I do? What do I do here? I add a spread to the discounting rate every time. You see that? Correct? This spread is called Z spread. Are you clear? Everyone? Why do I add this spread? Because I'm finding the value for a risky bond or a risk-free bond?
Risky bond.
Risky bond. So let me make you show that in the form of calculation. Suppose a 2-year government benchmark bond trades at 101.96. So what is the present value of the government bond? 101.96, right? It has a coupon of 3.224%. So the coupon is 3.224%, right? A 2-year corporate bond. So basically this is maturity is 2 years. And on maturity, how much do you get? Par. Am I correct? Right?
Yes.
Now they're saying a 2-year corporate bond also trades at the same price. So what if the corporate bond also at the same price? It's also for 2 years. It will also be par and has a coupon rate of 3.877. What is the G spread? How do I calculate the G spread? The G spread will be the yield on the corporate minus the government, right? So can you find the yield for corporate bond? What are the inputs? 101.96 negative PV, 100 par, 2N, 3.877 PMT, and CPT I by Y. Let me know your CPT. 2.85.
0.21.
2.8548. Is that you're getting for
Yes.
corporate bond? And for government bond, you just need to change one thing, that is coupon. So you do 3.224 PMT and then find CPT I by Y. You'll get 2.2114. Correct?
Yes.
So there's difference of 2.8548 minus 2.2114. That's nothing but that's called your G spread. Is that clear? G spread is the difference of yield between corporate bond and the risk-free bond. Clear?
Yes.
Now, can I say 0.643 is also called as 64 basis point? Correct? That's the spread, right? Now see the part B. Suppose in the above example, the 1 year and 2 year government spot rates are given 1.78 and 2.216. 1 year and 2 year spot rates. So I know what is the 1 year spot rate. 1 year spot rate means 1 year from today. It is 1.789%. And 2 year spot rate means 2 year from today, 2.216. What can you find from this? If you have 1 year spot rate and if you have 2 year spot rate, what can you find from this? You can actually find the forward rate for 1 year after 1 year, right?
Yes.
Of course, you may not have to do that, but I'm just saying you can find it. So here you have 1 year spot rate, you have 2 year spot rate, 1 year spot rate and 2 year spot rate. But these are yields for which security? Government security.
Government.
Can I discount my corporate bond with government security?
No.
I need to add a spread. That spread is called Z spread. So they said demonstrate that the Z spread is 64.6, which means what is going to be the coupon for how much duration bond? It's a 2 year bond. So what is the coupon for the corporate bond here that I have? What is the coupon? 3.877 I'll get in the first year, right? How much will I get in the second year? In the second year, I will put again 3.877 plus the par. Am I correct? Now, how should I discount the first year with? 1 plus, what is the spot rate for 1 year? 1.789% plus, now I'll add the Z spread. Now I'll add the Z spread. What is the Z spread here? 64.6 basis point. What is 64.6 basis point? It is called 0.646%. Are you getting it?
Yes.
That's for 1 year. So this is all raised to 1. Correct? For the second year, how will I do that? 1 plus, what is the 2 year spot rate? 2.216%, right? Plus 0.646% raised to 2. Are you getting it?
Yes.
Correct. I've added a constant spread that's called Z spread. Now, let's do the calculation of this. Remember, Z spread will not be told you to, they will not tell you to find Z spread, because practically finding Z spread, before you do the calculation, let me tell you, practically finding Z spread is difficult. It's not possible through your calculator. You have to do trial and error. Okay. So in exam, they will not ask you to find Z spread. They will give you the Z spread and then they will tell you to find the present value. So now check out that. First, find the denominator. So the first one will be 1.789 plus 0.646% plus 1. That's going to be the first denominator. So I'll do 3.877 divided by what I got this. I'll get 3.784839. Correct?
Yes.
That's store 1. Store that. Store 1. Now in the second part, do 2.216 plus 0.646% plus 1 and square it. You get 1.05. You'll get 1.058, right? Now inverse it and multiply that with 103.877. That's in the numerator. Whatever value you get, store 2. Add recall 1 and you'll exactly get what is the present value of this bond, 101.96. Is that clear?
Yes. Yes.
So what is this? Now you check out what was the question. Suppose that in the above example, 1 year and 2 year government spot rates are given. Demonstrate that the Z spread is 64.6, which means that I have to prove that using this Z spread, the bonds value will be equal to 101. So what is Z spread? Now see this. Z spread is the spread which makes the present value of the bond, as this, in this case, 101.96. So it's a constant spread every year added to the spot rate, which is the risk-free rate, which will give you the present value of the bond. Okay. So it's a constant spread added every time. As I said, in this question, it was given, they will always give you, because you can't manually find Z spread. You can find G spread, you can find I spread, you can find LIBOR OI spread, but Z spread you cannot find manually. That will be given to you in the question. They may just ask you to prove it. Clear? How will I prove it? I'll just plug in the value, and the value should be equal to the present value of the bond. Clear?
Yes. How come, like, practically they use the
spreadsheets? You can find that using the spreadsheets. So let's say you take the actual value of the bond, right? And you put that in the equation here and keep this missing. You keep that Z. So the spreadsheet will give you an answer. I mean, the software will give you an answer that what is the Z spread, which should equal to 101.9. You can manually also do it. You can randomly choose any basis point. For example, you can start with 25 basis point. Then you can keep on adjusting it 50, 100, or maybe less, depending on what the value is.
Okay.
So you can manually do trial and error, or you can directly find that using the spreadsheets. Okay. So Z spread is that spread which will equate your bond's value, that extra yield. If you add on the spot rates, that will give you the present value of the bond. Clear?
Yes.
Now, this Z spread is also used to find the to find the value of callable bonds or bonds with embedded option. So now, what if I find the Z spread for a callable bond and it turns out to be, let's say, 100 basis point. So ideally, when I find a Z spread for a non-callable bond, that Z spread is the extra risk for credit. It's an extra credit risk, right? Because that's going to compare the risk of a corporate and a risk-free bond, right? Correct?
Yes.
So isn't the Z spread more like a G spread for a non-callable bond? Correct? Z spread, that extra yield, is like a G spread. But a G spread, the problem, why it is not exactly G spread? G spread is the spread on the YTM, and YTM is a constant rate for all. YTM is not spot rate. What is the difference between spot rate and YTM? YTM is a single rate used for all maturity.
Yes.
But spot rate is the rate for various maturity. What is the more accurate thing, YTM or spot rates?
Spot rate.
Spot rate. So the spread that you keep on adding for every spot rate, that is Z spread, not G spread. G spread is the one single rate on all maturity, like YTM. Z spread is the spread added on the spot rate for all maturity. Clear?
Yes.
Now, I will like to suggest you to focus here and give me an answer. Now, when I find a Z spread for a non-callable bond, I get 100 basis point. This 100 basis point indicates me the risk over and above the risk-free rate, right?
Yes.
Correct? This is going to be for a non-callable bond. But for a callable bond, I get a Z spread slightly more. I get 150 basis point. Why? Because apart from the credit risk, there is one more risk in the callable bond. The risk of the option, the risk of the call, that the issuer can call back the bond anytime, right?
Yes.
Clear? So the Z spread for callable bond is not only due to the credit risk, but also due to the option, the risk of the option, right? Clear?
Yes.
So just without discussing anything further, can you tell me what is the Z spread for non-callable bond here? 100 basis point. For callable bond, it's 50 basis point more, and that 50 basis point is due to
credit because of the option.
Yes, because of the option. So that options in this case is going to be 50 basis point. That spread because of option is 50 basis point. Well, if I exclude that option spread, then I will get actual option adjusted spread for a callable bond. Correct? So can you read for me what is OAS here? Option. Yes.
An option adjusted spread is used for bonds with embedded options.
Embedded option like callable bonds, right?
Callable bonds, yes.
Okay.
It is the
spread
is the spread to the government spot rate curve that the bond would have if it were option free.
So option adjusted spread is the spread on the callable bond, assuming there is no call feature, which means very much like a typical bond, right?
Yes.
So you can't check the Z spread of a callable bond because that includes two things. That includes the spread because of option also, right? So you need to remove that part. Clear?
Yes.
That after removing, so from the Z spread of a callable bond of 150 basis point, if you remove the option value from it of 50 basis point, then what you get the spread is called option adjusted spread. Clear?
Yes.
So here from the Z spread, when I subtract the option value, which I got 50 basis point, then the spread I get is option adjusted spread. So in callable bond, you will check option adjusted spread or Z spread.
Option adjusted.
Yes. But in a non-callable bond, you can check out for Z spread. Because in non-callable bond, there is no option value. Clear?
Yes.
So the OS takes the option yield component out of the Z spread. Right? Clear? So can you tell me the difference? Can you read this part? Yes. I hope you have understood the formula, right?
Yes.
Understood the formula? Now, so can you tell me what is this, the last statement? Yes. Just complete the last statement. Yes.
The difference is the extra yield required to compensate bondholders for the call option.
Right. So example, if the callable bond has a Z spread of 200 basis point and the value of call option is 50 basis point, will you look at Z spread or will you look at OS?
OS.
And what is OS? 200 basis point is the total Z spread minus 50 basis point is due to option. So I can say the option adjusted spread is 150 basis.
150.
Clear?
Yes.
So in a non-callable bond, what will I add to treasury? The Z spread. But when it comes to the callable bond, of course you will add the Z spread, but you know that Z spread is a component of two things: the option value and the normal spread. So that's called the option adjusted spread. So they will tell you to find option adjusted spread. So option adjusted spread is not the Z spread in callable bonds. Option adjusted spread minus it's a Z spread minus the option value. Clear?
Yes.
Yes. So now if you check out the index, we've covered so many different varieties. We've covered everything about the yield curve, the spot rates, the forward rates, how to find the forward rate from the spot rates, how to find the bond value from the forward rates, what are different types of yield curve, and now different types of yield spreads. Is that clear?
Yes.
Well, that's the end of one of the most interesting but lengthiest topic of fixed income and maximum question you are going to get from this particular topic. Okay. Right. So this is where we end this particular topic. And now we can move to the next reading. Any doubts or anything with respect to this topic? Of course, you can ask that later also, but as of now, clear every concept?
Yes.
Right. And the reason of creating the index is so that you can probably, check out what all varieties of things we've covered. Clear? Okay. So now we are done with this topic and we'll move to the next video. Okay.